Welcome to Voice Daily Finance, the most important news personalized for you every day. Supported by Voice.com.
After listening to today's news, you'll know. First, Japan and South Korea issue a joint intervention threat as the yen nears 160, setting up a high-stakes battle against the surging US dollar. We'll explore how this currency crisis creates a policy dilemma for Asian central banks and risks a wider regional currency devaluation war. Second, Yara CEO warns of a 50% crop yield drop as soaring urea prices threaten to ignite a second wave of global food inflation. We'll analyse why this price shock is a key leading indicator and how it could force central banks to delay expected interest rate cuts. Third, the US abruptly withdraws a planned AI chip export rule, signalling policy chaos and creating massive uncertainty for NVIDIA and global partners. So we'll discuss why this policy whiplash acts as a hidden tax on the AI supply chain and what it means for global tech investment. The South Korean won just crashed through a psychological barrier against the dollar, hitting a low not seen since March of 2009. And it's not alone. The Japanese yen has plunged to a 20-month low, creeping dangerously close to the 160 per dollar mark, a red line many believe will force Tokyo to act. For countries like Japan and South Korea, a weak currency isn't just a number on a screen, it directly translates to higher prices for citizens. You see, both nations are heavily reliant on imports for critical goods like energy and food, which are almost always priced in US dollars. When the yen and won fall, the cost to buy those dollars goes up, and this imported inflation gets passed directly to consumers. This creates a terrible dilemma for their central banks. They could raise interest rates to strengthen their currency, but that would slow down their economies at a time of global uncertainty. It's a classic trade-off between currency stability and economic growth. This currency crisis is being fueled by a global rush into the US dollar, driven by safe haven demand amidst mounting US-Israeli tensions. A while back, we walked through the quiet, long-term push by central banks to diversify away from the dollar. Now, what really brings the current situation to a head is the paradox on display. Despite that slow diversification, when fear spikes, money still runs to the dollar. Interestingly enough, this isn't just a trend. It's a powerful reinforcement of the dollar's unique status. Even when a geopolitical crisis involves the US, capital from all over the world flows into the dollar for safety. This is wild because even other traditional safe haven currencies like the Japanese yen are being sold off to buy dollars. The latest IMF data shows that despite years of talk about de-dollarization, the US dollar still makes up nearly 57% of all central bank reserves. As we noted before, those numbers are a lagging indicator, but they confirm the dollar's real dominance, which only grows stronger in a crisis. That, in a nutshell, is the exorbitant privilege we discussed before. The move is battering economies that are heavily reliant on imported oil, which is priced in those very same dollars. Now, in a rare show of unity, the finance ministers of Japan and South Korea have issued a joint statement expressing serious concern. They've officially put the markets on notice, vowing to take appropriate actions against excessive volatility and disorderly movements. This is a direct threat of government intervention on a massive scale. To prop up their currencies, the Bank of Japan and the Bank of Korea would use their reserves of US dollars to buy up massive amounts of yen and won on the open market, aiming to increase demand and push the price back up. But the rabbit hole goes deeper. While Japan's finance minister publicly stated the government is fully prepared, some policymakers are privately admitting that intervention could be a losing battle. And they have a point. History shows this is an incredibly difficult fight to win. As recently as May 2024, Japan spent a staggering 9.8 trillion yen, over 62 billion US dollars to support the yen. And the effect was only temporary. Traders know this, and they are betting that without a fundamental change in global conditions, any intervention will be a drop in the ocean. They fear any attempt to prop up their currencies could prove futile against a tidal wave of dollar demand that will only intensify as long as geopolitical conflict persists. Here's an important angle for our listeners in China. The situation presents a fascinating duality. On one side, the yen and won are in freefall, while on the other, the Chinese yuan has remained relatively stable, acting as a sort of anchor. However, this exposes a new problem. A much weaker yen and won make Japanese and Korean exports cheaper, putting Chinese exporters at a disadvantage. This raises a critical question. Will China be forced to let the yuan weaken to maintain its competitiveness? If so, it could trigger a new round of currency devaluations across Asia. This sets the stage for a high-stakes confrontation. On one side, two of Asia's largest economies drawing a line in the sand. On the other, a global market moving with a force they may not be able to stop. So, what should we watch for next? The immediate focal point is that 160 yen to the dollar level. If the market breaches it, the pressure on Japan to act will be immense. Also, keep an eye on the daily fixing rate of the yuan. Any signs of a significant downward adjustment could signal a major policy shift. Ultimately, the direction of these currencies will hinge on whether geopolitical tensions ease and when the US Federal Reserve signals a change in its interest rate policy. We were just talking about how geopolitical tensions are sending shockwaves through currency markets. Well, that same instability is now threatening to ignite a second wave of global food inflation. The head of one of the world's largest fertiliser companies just issued a chilling warning. A prolonged Iran conflict could slash some crop yields by as much as 50%. That explosive number comes directly from Svein Torholsether, the CEO of Yara International, and the markets are already proving him right. In just 2 weeks, the price of urea, a critical fertiliser component, has shot up from $487 to $700 a tonne. Now get this, the surge in key fertiliser costs is a powerful leading indicator for future food prices. Research from the IMF shows that historically, about 45% of any increase in fertiliser prices passes through to global cereal prices within a year. This means the price shock we're seeing now could force central banks to delay expected interest rate cuts, extending the cost of living crisis, especially in emerging markets. The reason for the shock is simple geography. The Gulf region supplies a third of the world's urea. Now, that supply is being choked off. Holsether calls it a double impact, as the price of natural gas, also essential for production, is soaring at the same time. This is creating a dangerous negative feedback loop, especially for Europe. After all, natural gas makes up a staggering 70 to 90% of the production cost for nitrogen-based fertilizers. So, as gas prices soar, Europe's own fertiliser plants are forced to cut production or shut down, which then forces them to compete on the global market for even more expensive imported fertiliser, essentially compounding their own inflation problem. But if that was just the appetizer, the main course is just being served. Holsether warns that a global auction for fertiliser is now underway, where Europe's buying power will likely outbid poorer nations. This decision brings both food security for some and comes with inherent risks of instability for others. We're seeing Europe striving to secure its supply chain, while at the same time, this dynamic creates a sharp divergence in food security, hitting nations in Africa and beyond with a severe negative terms of trade shock. The UN World Food Programme echoes this, stating that rising prices will worsen hunger for the most vulnerable. And this power struggle has another dimension. The disruption in the Gulf could open a door for other major producers. For example, China could strategically use its fertiliser supplies to expand influence in the global south, offering stability in exchange for access to strategic resources. This is a key trend to watch. Holsether delivered the ultimate warning shot. For some European summer crops, a 50% reduction in yield could be seen in the very first harvest without fertiliser. He added that if the critical Strait of Hormuz shipping lane were closed for a year, it would be catastrophic. As the CEO put it, this has global implications, and the world needs to grasp the magnitude before it is too late. So what's next? The key is to watch the divergence in profitability between fertiliser producers. Companies in North America are largely insulated from this crisis because their natural gas costs are much lower. This gives them a huge competitive advantage and could lead to a major reshuffling in this critical global industry. This is a rapidly developing situation, and the full ripple effects on global food security are just beginning to unfold. Speaking of high-stakes global industries being reshuffled, the battle for AI supremacy just hit a major plot twist. A planned rule from the US Commerce Department designed to reshape the entire AI chip export market has been suddenly withdrawn, signaling a major policy scramble. This kind of policy whiplash creates massive uncertainty, acting like a hidden tax on the entire AI supply chain. So the thing is, companies like NVIDIA and their partners plan their major investments in factories and equipment years in advance, When the rules of the game keep changing, they are forced to delay these huge investments. This can slow down global AI deployment, and ironically, even risk eroding America's own tech leadership. Policy zigzags like this don't just freeze investment, they can also complicate central banks' timing for rate cuts. This wasn't just any rule. It was the Trump administration's aggressive answer to a Biden-era regulation, which was rescinded in May 2025. The proposed plan was a radical departure, and here's where it gets interesting. It considered requiring foreign countries to invest directly in US data centers or provide major security guarantees just to get their hands on large quantities of American AI chips. This decision would have signaled a fundamental change in US policy. Instead of relying on long-standing alliances, the US would trade access to its technology for direct economic benefits, essentially asking other countries to pay to play. This could function as a novel way to fund American tech infrastructure, like data centers, using foreign direct investment instead of US taxpayer money. This pivot would shift more burden onto partners like South Korea and introduce fresh supply chain volatility, exactly the kind of risk we warned about. The numbers in the draft were staggering. For exports of 200,000 chips or more, countries might have been forced to make those massive investments. But just as the tech world was bracing for this new reality, the rule vanished. When asked about the reversal, a US official stated, "This supposed rule was always a draft and remains a draft," adding that all discussions were preliminary. This abrupt withdrawal exposes a fierce debate raging within the administration about the right way to achieve global AI supremacy. Believe it or not, this indecision in Washington is being watched very closely in Beijing. It offers a golden opportunity for China to accelerate its indigenous semiconductor development and court neutral nations with its own technology stack. Some analysts believe that every month of US policy confusion could translate into a year of closed technology gaps by China. We're already seeing reports that Chinese firms like SMIC are making progress on more advanced chips. While their costs are higher and yields are lower than leaders like TSMC, they are moving forward, potentially undermining any future US restrictions. Now, with the new rule pulled and the old one rejected, the strategy is in limbo. This isn't just a policy revision, it's a clear signal of a high-stakes power struggle over the future of the world's most critical technology. So, what should we be watching for next? First, all eyes are on the Commerce Department for any sign of a clear, stable replacement rule. Second, we should monitor foreign direct investment flows into US tech infrastructure, a key indicator of whether this investment for access idea continues unofficially. Third, keep an eye on South Korea's monthly semiconductor exports and memory price indices as a market barometer. And finally, watch the composition of South Korean shipments into China if those flows strengthen. That's your early read on China's domestic AI progress, which remains the most important long-term measure of the strategic stakes.
That's it for today on Voice Daily Finance. Follow, share, and stay tuned for daily updates coming your way tomorrow.